Have you ever felt like you're just uh, drowning in information, prepping for a big meeting, trying to get your head around something new, or even just plain curious, and there's just so much data, it can be completely overwhelming, right? Well, that's exactly why we do the deep dive. Think of it as your shortcut to clarity, cutting through all that noise to get to what really matters. Today, we're plunging into financial reporting, specifically the FRS 101 Reduced Disclosure Framework. And this isn't just about numbers. It's really about smart, efficient, and, well, proportionate information sharing. It affects real companies, especially here in the UK and the Republic of Ireland. So our mission today is to unpack this FRS 101 framework. What's its purpose? Who's it actually for? And maybe most interestingly, what are some of the surprising twists and turns it brings to financial transparency? We'll look at how it helps certain companies streamline their reporting, without totally sacrificing what users need to know. It's a really crucial bit of the regulatory puzzle, and we're digging into the official source, the Financial Reporting Council. That's the FRC's FRS 101 Reduced Disclosure Framework document, the September 2024 version. It's pretty dense stuff, but don't worry, we've pulled out the key insights for you.
Okay, so let's start with the basics. What is FRS 101? Well, it's an optional standard issued by the FRC, and it applies in both the UK and the Republic of Ireland. Its main objective, its whole point really, is to provide a reduced disclosure framework. But, and this is key, it's specifically for the individual financial statements of subsidiaries. That includes intermediate parents and also ultimate parent companies preparing their own individual accounts.
Okay, let's unpack that a bit. So fundamentally, it's about making financial reporting less of a burden for certain companies. Is that right?
Precisely. The FRC's sort of overriding goal here is making sure users get, and I'm quoting loosely here, high quality, understandable financial reporting proportionate to the size and complexity of the entity and user's information needs.
Right.
And the why behind it is important too. FRS 101 came about because pushing all subsidiaries onto either, say, FRS 102 or full IFRS, well, that caused problems. Companies either had to keep track of complex accounting differences or face this huge jump in disclosures, stuff that wasn't always super relevant for the individual company's accounts. So FRS 101 offers this IFRS-based approach, but crucially with specific exemptions from some of the disclosure requirements.
Got it. So if you're one of these qualifying entities, using FRS 101 could save a lot of hassle, time, and resources while still giving stakeholders the info they actually need at that level.
That's exactly the idea. It's meant to be a practical solution. But let's nail down this qualifying entity term. Who actually gets to use FRS 101? Okay, so a qualifying entity is basically a member of a group where the parent company prepares publicly available consolidated financial statements. And those statements have to give a true and fair view, and importantly, the subsidiary we're talking about must be included in that consolidation.
Okay, that makes sense.
And remember what I said earlier, it's only for individual financial statements, not consolidated ones. Even if a company chooses to prepare consolidated accounts voluntarily, FRS 101 doesn't apply there.
Why is that distinction so strict about individual versus consolidated?
Because consolidated statements usually serve a wider audience, investors, creditors, looking at the whole group. They generally need that full, comprehensive picture with all the detailed disclosures. Individual statements often have a slightly different user base or focus.
Okay, here's something I found really interesting in the source material. It says, even if the main group uses a totally different framework for its consolidated accounts, say full IFRS, the individual subsidiary can still use FRS 101. That sounds incredibly flexible.
It is, and it's designed that way. Think about large multinational groups. The parent might use full IFRS globally, but a UK or Irish subsidiary can use FRS 101 for its local statutory accounts. It simplifies things locally without forcing them onto the full, complex global framework, as long as they meet the FRS 101 criteria and, critically, still comply with local company law.
Okay, but it's not for everyone, right? You mentioned exclusions.
Correct. There are some important ones. Charities, for example, can't be qualifying entities. And there's a specific exclusion for entities, mainly insurers, that have to apply Schedule 3 to the Companies Act regulations and also have insurance contracts under IFRS 17.
Ah, okay. So insurers have their own specific regime.
Essentially, yes. The idea is to make sure they stick to company law requirements designed for their specific, highly regulated industry, rather than using the FRS 101 route.
Right. Let's get into the main event then. The disclosure exemptions. How does that actually work? You get exemptions, but you still have to follow IFRS for the numbers themselves.
Exactly. A qualifying entity can take advantage of the specific disclosure exemptions listed in FRS 101, but, and this is a big but, but they must still apply the recognition and measurement requirements of adopted IFRS, and the disclosure requirements too, except for those specific exemptions. Plus, they always need to make any necessary adjustments to ensure they comply with UK or Irish company law.
So it's definitely not a free-for-all. It's a tailored approach.
Yeah.
What must they still disclose, even if they're taking exemptions?
Good point. Even with exemptions, they absolutely must disclose a brief summary of which exemptions they've actually adopted. And they also have to state the name of the parent company that prepares the consolidated accounts and where those accounts can be obtained. Transparency about using the framework is key.
Okay. And what's the logic behind which disclosures get exempted? Is there a set of principles?
Yes, the FRC outlines three main principles they considered when deciding on exemptions. First, relevance. Is the disclosure actually useful to the users of these specific individual financial statements, especially given that group accounts exist?
Okay.
Second, the cost constraint. Do the costs of preparing and providing that specific disclosure outweigh the benefits for the users of the individual accounts?
Makes sense.
And third, avoiding what they call gold plating. Basically, FRS 101 shouldn't override an exemption that already exists in company law.
Right. Don't take away an existing simplification. Okay, can we look at some specific examples? Financial instruments seem like a big area.
Absolutely. For financial instruments, under IFRS 7 and IFRS 13, there are usually really extensive disclosure requirements. Think complex derivatives, risk exposures, fair value details. FRS 101 generally offers significant relief from these. However,
There's always a however.
there usually is, unless the entity is a financial institution. So think banks, building societies, insurers, investment trusts, basically, companies whose core business is financial instruments. These types of entities cannot take the exemptions from IFRS 7 or the parts of IFRS 13 related to financial instruments.
Okay, so like we said before, if it's your main business, you need full transparency on it. Makes sense. What about cash flow statements?
Right, the statement of cash flows, IAS 7. Qualifying entities can be exempt from preparing this statement and all the related notes, provided another condition that equivalent cash flow information is included in the consolidated financial statements of the group.
So the info is still available just to the group level.
Exactly. The aim here is really cost saving for the individual subsidiary, avoiding duplication.
What about transactions within the group? Related parties?
Good one. For related party transactions, IAS 24, there are specific exemptions. For instance, transactions between two group companies that are both 100% owned within that group don't usually need to be disclosed in the individual accounts. There are also exemptions relating to key management personnel compensation when it's provided by a separate management entity within the group. Again, it avoids redundant disclosures within the group context.
Okay. What about big standards like revenue and leases, IFRS 15 and 16?
Yes. For revenue, IFRS 15, and leases, IFRS 16, FRS 101 provides exemptions from many of the detailed disclosures, particularly the more qualitative ones. The thinking here is partly that users of individual statements might be more focused on the balance sheet position, and also that basic company law still requires certain essential disclosures about turnover and commitments anyway.
Interesting. And you mentioned Pillar 2 earlier, the global minimum tax rules.
That's right. Under income taxes, IAS 12, specifically concerning the OECD's Pillar 2 rules for top-up taxes, there are exemptions available for certain Pillar 2 disclosures in the individual accounts. Again, the condition is usually that equivalent information is provided in the parent's consolidated statements.
Why that exemption specifically?
Because the Pillar 2 top-up tax liability is ultimately determined and often paid at the group level, not by each individual subsidiary in isolation. So duplicating detailed calculations and disclosures everywhere might not be the most useful approach.
Okay, one more. What about companies switching to FRS 101?
First-time adoption. FRS 101 offers relief here too. Specifically, under IFRS 1, you normally have to prepare an opening balance sheet at the day you transition. FRS 101 provides an exemption from presenting that opening statement of financial position, which can simplify the transition process quite a bit for companies adopting it for the first time.
Wow, okay, so quite a range of tailored exemptions. But you keep mentioning this interaction with company law. That sounds like where things could get, well, complicated.
That's putting it mildly sometimes. This is probably the most critical point to grasp about FRS 101. As we noted, financial statements prepared under FRS 101 are not IAS accounts or full IFRS accounts. They are legally defined as Companies Act accounts. Meaning they must, first and foremost, comply with the Companies Act, the 2006 Act in the UK, or the 2014 Act in the Republic of Ireland and all the related regulations, like the accounting regulations, Schedule 1.
So even if FRS 101 says you're exempt from disclosing X, company law might say, oh, no, you still have to disclose X.
Absolutely. Company law requirements often override the FRS 101 exemptions. For example, there are specific legal requirements about disclosures for financial instruments measured at fair value that apply regardless of any FRS 101 exemption. The law takes precedence.
Okay, this sounds like a potential minefield. Can you give us a really concrete example of a direct conflict?
The classic one is goodwill amortization. Under IFRS 3, which FRS 101 generally follows for recognition and measurement, you don't amortize goodwill if it has an indefinite useful life. You test it for impairment instead.
All right, standard IFRS practice.
UK company law, specifically paragraph 22 of Schedule 1 to the regulations, is very clear. Acquired goodwill must be written off systematically over its useful economic life. If you can't estimate that life reliably, it shouldn't exceed 10 years.
Whoa, okay. That's a direct clash. So what do companies actually do?
This is where it gets fascinating. Because the company directors also have an overriding legal duty to present accounts that give a true and fair view. If they believe that not amortizing goodwill, following the IFRS principle, gives a truer and fairer view than the strict legal requirement to amortize it, they can invoke what's called the true and fair override.
An override. So they deliberately break the specific rule.
They deliberately depart from the specific rule, yes, but they have to explain why in the notes to the financial statements, why applying the rule would be misleading, and why departing from it gives a truer picture. So most UK companies applying FRS 101 and having goodwill will include this true and fair override disclosure to justify not amortizing it, aligning with IFRS principles but acknowledging the departure from the specific legal paragraph.
That is surprising. It shows financial reporting isn't just ticking boxes. It involves significant judgment and navigating these legal versus standard tensions.
Absolutely. And it's not the only area. Look at fair value gains and losses. Under IFRS 9, certain gains or losses, like those from changes in a company's own credit risk on liabilities measured at fair value, go to other comprehensive income, OCI, not the main profit and loss account.
Okay.
In the UK, putting those kinds of gains and losses directly into OCI usually requires another true and fair override explanation. This is because a specific paragraph in the UK Companies Act regulations, paragraph 4 of Schedule 1, generally implies such items should hit the P&L.
So another override needed in the UK. What about Ireland?
And here's a great example of jurisdictional differences. In the Republic of Ireland, due to slightly different wording in their Companies Act, presenting these specific fair value changes in OCI, as IFRS 9 requires, generally does not require a true and fair override for certain types of companies.
Really? So the same accounting treatment gets a different legal interpretation depending on whether you're in London or Dublin.
For that specific item, yes. It highlights how subtle differences in national law interact with the overarching IFRS framework applied via FRS 101.
Fascinating. What else does company law dictate? Formats.
Yes, statement formats. Entities using FRS 101 must use the balance sheet and profit and loss account formats prescribed in the Companies Act regulations. These formats can look quite different from the presentation format suggested in IAS 1, the IFRS standard on presentation. Things like the definition of fixed assets versus non-current assets, or how things like extraordinary items are handled. UK law still has a concept of extraordinary items, which IFRS effectively eliminated years ago.
So the basic layout of the accounts is driven by local law, not IFRS.
Correct. And another big area is realized profits. UK company law has a fundamental principle that only realized profits can be distributed as dividends. However, the law itself creates specific exceptions. It explicitly allows certain fair value movements on things like investment properties, biological assets, living animals, plants, and certain financial instruments to be recognized in the profit and loss account, even though they might not be considered realized in the traditional sense.
So the law acknowledges modern accounting for certain assets.
It does. It allows these specific fair value gains to be included in distributable profits in certain circumstances, overriding the general realized profits only rule for those items. But again, there can be jurisdictional differences. For instance, while UK law permits valuing stock, inventory at fair value in some cases, like agricultural produce, Irish company law generally does not.
Right. It really paints a picture of FRS 101 sitting at this complex intersection of global standards and very specific national legal rules.
That's the perfect way to describe it.
And given all this complexity and the changing environment, it sounds like FRS 101 itself isn't set in stone. You mentioned updates.
Oh, definitely. FRS 101 is very much a living document. The FRC reviews and updates it periodically. This is essential to keep it aligned with changes in the underlying IFRS standards it's based on, changes in company law in both the UK and Ireland, and also to respond to feedback from companies and auditors using it.
So what have been some of the key changes over the years?
Well, one quite significant one back in 2016 was the removal of the requirement for qualifying entities to actually notify their shareholders individually that they were planning to use the FRS 101 disclosure exemptions,
Why did they remove that?
primarily for cost effectiveness. It was seen as an administrative burden, and the rationale was that shareholders still get the full picture from the publicly available consolidated financial statements anyway. Then, of course, there were amendments in 2020 specifically related to the UK leaving the European Union. These mostly involved updating legal references, like changing EU-adopted IFRS to the broader term adopted IFRS, which covers IFRS as adopted in the UK post-Brexit.
Logical adjustments.
More recently, there was the Periodic Review 2024. This led to a set of amendments finalized in March 2024, which will become effective for accounting periods starting on or after January 1st, 2026. These often involve fine-tuning existing exemptions or clarifying guidance. And as we discussed, specific amendments were made in July 2023 to incorporate exemptions related to those new international Pillar 2 tax rules, keeping the standard current with global tax reforms.
It sounds like the FRC is constantly trying to keep it practical and relevant, which must be reassuring for the companies using it.
I think that's the aim, yes, to maintain that balance between simplification and appropriate transparency.
Okay, so let's try and pull this all together. What does this deep dive into FRS 101 mean for you, our listener? We've explored this framework, FRS 101, designed for proportionate, clear, and efficient financial reporting. It's specifically for certain qualifying entities, subsidiaries, and parents in the UK and Republic of Ireland. It really tries to strike a balance, doesn't it? Offering these disclosure exemptions where the information might be seen as redundant, perhaps because it's already out there in the group's consolidated accounts, or maybe just less relevant for the users looking solely at that individual company.
That's the core idea. It leverages the existence of those comprehensive group statements.
And the key takeaway seems to be that knowledge, financial information, is most valuable when it's actually understood and applied effectively. FRS 101 is a tool that aims to streamline the reporting process without hopefully sacrificing transparency where it really counts for those individual entities.
It relies heavily on that group context, providing the bigger picture.
So here's a thought to leave you with, something to mull over. This whole framework, FRS 101, really throws a spotlight on that constant tension, that interplay between global accounting standards like IFRS and specific national legal requirements, like the Companies Act here. How do you think these ongoing interactions, this sort of negotiation between global principles and local laws, how might that shape the future of financial reporting and transparency? Especially in our increasingly interconnected global economy, what could that mean down the line for investors, for lenders, for businesses operating across borders? It's a complex dance.
It really is. It raises questions about comparability versus national specificity.
Well, we hope this deep dive has given you a much clearer picture of FRS 101 and maybe some of the fascinating complexities hidden within financial reporting rules. It might seem like a dry subject sometimes, accounting standards, but as we've seen today, it's actually full of strategic choices, careful judgments, and these intricate legal dynamics that genuinely shape how businesses tell their financial story.